All right. If you've spent any time at all in DeFi, you know the feeling, right? That constant hunt for the perfect investment, the one that feels like the holy grail. Today, we're going to dive into one protocol's really ambitious attempt to build exactly that.
And this, right here, is the heart of the problem for everyone, the DeFi yield trilemma. I mean, you can get those juicy high returns, but then your funds are either locked up tight or it's some serious risk. Or, hey, you can get instant access to your money, but you're leaving a ton of yield on the table. And then there's the safe route, but the returns, they're barely there. For years, the frustrating reality has always been you get to pick two, if you're lucky.
So enter Maple Finance with what they think is the answer, syrupUSDC. Now, yeah, it's a yield-bearing stablecoin, but the really crucial part is where that yield comes from. We are not talking about some crazy, high-leverage algorithmic play here. The yield is generated by lending good old USDC to vetted, real-world institutions. Think of it like a bridge from traditional finance straight into the world of DeFi.
The engine behind this whole thing is actually deceptively simple, and it's all built on a four-step process. So first, you deposit standard USDC. Maple's institutional lending arm then lends that capital out. Now, the borrowers who've been thoroughly checked out have to post more collateral than they borrow, usually in blue-chip stuff like Bitcoin and Ether. And then, when they pay interest on those loans, that yield flows directly back to you, which increases the value of your syrupUSDC. Simple as that.
Okay, so does it actually work? Well, this number speaks volumes. Since they shifted to their in-house underwriting model, Maple has kept up this really impressive loan repayment rate. This one little data point is a super powerful indicator of how seriously they take risk management.
So how do they pull off that kind of safety record? Well, it really comes down to a layered defense. Over-collateralization. That's the first and most important backstop. Behind that, you've got a dedicated team on call 24/7, ready to manage margin calls at a moment's notice. The collateral itself, it's held by institutional-grade custodians. And, the best part for all of us DeFi natives, it's all completely verifiable on-chain.
So we've covered yield and safety, but what about that third piece of the trilemma? Liquidity. This, right here, was the game changer. Maple went and set up deep liquidity pools on major decentralized exchanges, and that means no more lockups, no more annoying waiting periods. You can swap your yield-earning syrupUSDC back into regular USDC whenever you want, basically solving that final piece of the puzzle. So the picture looks pretty perfect, doesn't it? A safe, liquid, high-yield product. But you know how it is in DeFi. The real test always comes when the market starts to panic. And in November of 2025, oh boy, it panicked hard. It was a nasty chain reaction, started by a few exploits and collateral failures, and it led to the sudden collapse of 3 other yield-bearing stablecoins. And just like that, it triggered this massive flight to safety across the entire ecosystem. It was a true, brutal stress test for every single protocol in the space. I mean, just look at the data from that week. It shows you just how brutal it was. Some assets lost over 80% of their total value locked. Now look, syrupUSDC wasn't totally immune to the fear. It saw a 10.6% drop. But when you compare it to its peers, it weathered that storm remarkably well, and it showed a kind of resilience the market clearly noticed.
Surviving a market crash, that's one thing. But syrupUSDC was about to face a completely different kind of trial. A full-on technical and security audit to get listed on the lending giant Aave. You could call this the ultimate public due diligence.
You see, to even be considered, a project has to be completely picked apart by DeFi's top digital detectives. We're talking about firms like LlamaRisk, Chaos Labs, and BGD Labs who publicly scrutinize every single line of code, every assumption, and every potential risk you can think of.
And you know what? They found some critical issues. BGD Labs flagged 3 major blockers. First, a super powerful admin role called the governor could upgrade court contracts instantly, totally bypassing safety time locks. Second, actions that could devalue the token in a crisis, well, they weren't time-locked either, creating a huge risk of sudden liquidations on Aave. And third, the exchange rate itself could actually be manipulated. Not good.
But here's the crucial part. Maple's response wasn't defensive. They listened and they built. This moment really represents a pivotal shift, not just for Maple, but for DeFi as a whole. It's this move away from the old code is law mentality towards a more mature, collaborative approach to security. They hardened the protocol right there in public view, putting in a mandatory 24-hour time lock and publishing a clear procedure for how they'd handle any loan impairments.
So what was the final verdict? Well, it wasn't a blank check. It was a very carefully calibrated approval. Chaos Labs recommended listing syrupUSDC, but with some strict guardrails. It wouldn't be borrowable, and critically, it could only be used as collateral in Aave's special E-mode. That's a high-efficiency setting designed just for stablecoins, which contains its risk while still enabling its primary use case.
So, after surviving a massive market crash and passing the Aave gauntlet, what does this whole journey really tell us about where we're at?
You know, the story of syrupUSDC isn't just about one token. It's really a case study in how DeFi protocols mature. It shows how a really promising idea can be battle-tested by the sheer chaos of the open market, and then hardened and made safer through the rigorous, transparent scrutiny of its peers.
It really feels like DeFi is closer than it's ever been to finding that holy grail of a safe, liquid, high-yield asset. But this whole journey also reveals a crucial truth, that real-world yield from institutional credit also brings real-world counterparty risk right into the heart of DeFi. So the question that leaves us with is, as this model gets copied and scaled, is the ecosystem truly ready for what comes next?